Good morning, all. Thursday. Hold on.
We
don't want that. Thursday, July 14th. Another day in paradise. Never a dull moment. We got a great show in store today. Ivy Zelman, who needs a little introduction, the preeminent housing analyst in the country. I've had the pleasure of knowing Ivy for 20 plus years. I knew her when she was a nobody. Now she's a big shot, and we're so thrilled that she's willing to come and share her wisdom with us. We've got a great space here, as everyone knows. We're all just trying to help each other and trying to get the truth out to folks to help empower them to make the right investment decisions. And it's really just fantastic. We had Larry Jevelo in the room on Tuesday. Now I've got Ivy in the room today to help us on housing. I know it's a subject which is near and dear to most of us in this room. Let me just go on a little bit of a rant for a couple minutes, and we're going to get right into it. And we can revisit some of these other topics later in the show. Yesterday was all about inflation, CPI. It's funny, watching the talking heads on mainstream media just blows my mind. I tend to watch Bloomberg television more than the Cartoon Network, CNBC. They're better, but even no one could have predicted this. Nobody predicted this. My God, if you just were on Twitter and read the Cleveland Fed, I mean, they were predicting 10%. Okay, they were a little over the top, but it shouldn't really come as a surprise to anybody. And look, nobody knows the future. We're all just trying to give it our best. If we're any good at this, we're wrong 40% of the time. But the same crowd that was telling you inflation was transitory a year ago, they're the ones who've been saying for month after month after month it's peaking. And that's the wrong question. I can totally get that maybe it's peaked, but that's the wrong question. The right question is, how long will it take for inflation to come down to a level where the Fed can start easing up on the brakes a little bit? They have this dream of 2.4% inflation by the end of 2023. To paraphrase my inner Jeremy Irons from Margin Call, please explain to me how it's going to happen. Pretend I'm a small child or a golden retriever. As I've said it once, I'll say it a million times. You need to have a significant slowdown, recession. There, I said it, the R word. Recession. People have to lose their jobs in order to get inflation under control. There is no Goldilocks. Rather do the right thing and throw the economy into recession, free up the slack resources to cause pricing to come off the boil. Not just, and the issue isn't, will inflation come down to 5%? It's still too high. So for me, it's a question about how long is it going to take inflation to come down to an acceptable level. And the longer that takes, the longer monetary policy has to remain restrictive, the worse it is for risk assets. And as all of you know, have been in this room with me for the last 6-7 months, equities continue to represent return-free risk, in my opinion. So that was all the excitement yesterday. Some other things today, and I was going back and forth with 3 aces. He direct messaged me, something's going to break, you're damn straight. You got the DXY at 108.91, dollar making, 20-year new high. The yen to 139, the euro briefly broke parity. I mean, the wheels are coming off this thing. The great Michael Howell, I urge everyone to go back and listen to the interview he did with Real Vision earlier this week, explaining how Europe is most certainly already in recession. The U.S., we are in one, we're about to go into one. Let's not argue over what month it's going to happen. The housing market is rolling over, and that's what our guest today is going to talk about. For those of you who saw the Lucky Lopez video about repos and automobiles, you would see that trouble's brewing in the automobile industry as well. And then you read some of the news coming out of Europe where they're going to be turning off the gas. The Russians are going to be turning off the gas. French electricity prices up 8x. And you look at earnings. Earnings, and this is probably the key point. I think we are now descending into prolonged bear market for corporate profits. We can debate that later in the show, but I think earnings, Michael Belkin was in here a few weeks ago, said 110, whatever. That's not the point. The point is direction and depth. Street consensus is for $240 in S&P earnings for next year. Anyone want to take the over-under at 200? Fine, bring it to me. 180, bring it to me. 160, bring it to me. You want to bet on 110? No. But as the great Michael Kantrowitz has said once, he said numerous times in this room, and we heard it first here, right, Aces? Kantrowitz now is saying it on CNBC. The first half of the bear market was all about valuation compression. Now starts the earnings downturn. So again, equities continue to represent return-free risk. What should you do? For a normal, well-adjusted person, hold a lot of cash, be defensive, go to the beach for the summer, you're not going to miss anything. If you got larceny in your heart, take too much risk, short some things. But I have no sympathy for anyone who comes in this room and leaves and is still long. And don't come crying back to me when the October lows and we're down another 20% from here. Because, Cantor's calling 3,000, Michael Wilson, Morgan Stanley's calling 3,000, Michael Howell, Michael Belkin. I just, I don't have all the answers. I know how to ask the questions. And when I get lost, I turn to people I respect. I said this in the room the other week. And when a uniformly the smart people I look up to are all singing from the same prayer book, that informs me. The smartest guys I know in this business are negative. Someone asked me on Twitter the other day, anyone I respect bullish? No. Absolutely not. What about Jim Cramer? I said anyone I can respect. I stopped. All right, let's get to the business at hand. So we're very privileged to have Ivy Zelman with us. Ivy has forgotten more about housing than I will ever know. I will try to keep up with her and ask semi-intelligent questions. But this is going to be a lot of fun because I know a lot of you have been asking for a housing guru the last couple of months, and Ivy played a little bit hard to get, but we finally got her. So here she is. So Ivy, I want to welcome you to the room, and maybe it'd be a good place to start off. People, you have kind of a low profile. You're on CNBC and some of the other social media from time to time, but you're not as highly exposed as some other talking head gurus. I won't call you a talking head. Maybe you could just talk a little bit about your background and what you do and what Zelman Associates does. Ivy, the floor is yours.
Great. Well, thank you so much, and great choice on the song, George. Love the opening, and it's my pleasure to be on in the space with everyone, and appreciate the opportunity. Well, I guess I'm an old dog now. I could say I've been following the housing market for over 30 years. But given that, I guess the new when you're 50s is the old, 40s or whatever. But I started my career off a little later than most because I went to night school to put myself through college. I was working full time. And when I graduated, from George Mason University, that no one ever heard of because state school until we went to the Final Four many years, decades later. But I got a job working at Zelman Brothers in their 2-year financial analyst program, investment banking, which I hated. But it was a great bridge. And after the 2 years, I applied to Harvard, Stanford, and Northwestern and worked really hard on my GMATs and my essays, and they didn't want me. They rejected me. So I just needed a job in the midst of a recession. And the lights were going out back in the Treasury scandal when John Goodfriend had to step down. And I just needed a job and got a job in equity research as an associate working for Bruce Harding, who picked up housing as a favor because Bob Bishop walked out and said, I'm out of here, who had very successful investor running Impala, buy-side guy. Anyway, long story short, after Solly equity research for 6 years, they got bought out by Smith Barney and I lost my job. I thought I was devastated, but Credit Suisse offered me an opportunity. I worked there 10 years until left in 2007 in the midst of what was clearly beginnings of we thought that we knew that the crisis was already starting, but the magnitude of it. And I started Zelman in October of 2007. And we were independent up until July of last year when we sold a majority stake to Walker Dunlop, who is a public company that focuses predominantly on the commercial real estate market, multifamily, providing financing and investment sales and a whole bunch of other stuff. So That's sort of the summary. And Zelman has been focused, and my career, we're exclusively focused on macro housing and the top 50 MSAs and anything to do with housing in our ecosystem, from new construction, existing home sales, home prices, home improvement, the rental market, mortgage market. I'm sure I'll forget something in there, but really stick to our niche, which is housing. So I'll turn it back to you, George. Happy to be on.
That's great, Ivy. So there's a lot to talk about. I will put some slides up as we go along. Ivy forwarded me her deck early this morning. I'll throw a couple slides up, but we don't want to have death by PowerPoint. However, oftentimes it's more all visual. It's interesting to see slides. So let's start from sort of the general high level, and then we'll get progressively into it. So Ivy, where are we in the cycle? Housing totally got destroyed in the great financial crisis. It was the epicenter of all the mortgage-backed security nonsense and whatever. And we've been in this great up and to the right liquidity-driven economy. It's pulled housing along with it. I know we had a big housing deficit going back a number of years ago. So where are we in the cycle right now with respect to housing, Ivy? Could you contextualize it for us, please?
Sure. So our view is that housing has peaked. If we talk about the level of demand or a level of new home sales, existing home sales, while we had already seen existing home sales rolling over in 21 and into 22, it was really a lack of supply. But now the deceleration we're seeing is clearly demand driven. So we're definitely past the peak, and the market is rapidly deteriorating. And I think that we're seeing the impact really from predominantly the surge in rates and very stretched affordability, like almost at record levels of stretched affordability. So we expect that it's going to be a continuation and more rapid than we've seen in any prior period, as the consumer is much more in tune to the information flow that's available to them.
So that's useful. So Ivy, I'm putting the slides up as we speak. So those of us that sort of housing tourists, we see these articles, we see these graphs, and maybe you can give us a little granularity to this for like the typical home, which is, I don't know, $400,000 or whatever it is. I've lost track of it. $400,000, and for the typical payment and blah blah blah. I've seen all these things. They say, the average payment in the average home was X a year ago, and now it's like up 80% or some crazy number like that. I mean, is affordability is pretty goddamn awful as compared to the overall scheme of things, isn't that?
Absolutely. Entry-level buyers right now, the monthly payment to purchase a new home is up about 50% year over year. And I think that what we've seen in the last, call it 30 days, a big surge in the number of people that had contracts that are canceling. And some of the cancellations in the new home backlog is a result of builders scrubbing their backlog, especially for the build to order builders, where they're actually a person has signed a contract and is waiting for their home to be completed. What you're seeing are people that no longer, when you underwrite them at the new rate, can afford it. So they're actually canceling the customer, but you're also having customers that have signed contracts within the last 6 months that are canceling. And cancellation rates, just to give you some perspective, have historically averaged between 15 to 20% in the new home market. And that fell to single digits, 5% prior to this, call it last 6 months. And now, just according to our data, nationally, we're at 17%. But we have a weekly data series that we publish that's focused just on Arizona, Nevada, and California MSAs. And that number is running about 34%.
Whoa. Stop press. 34%? Are you serious?
Yeah. 34%, and it was 36 the prior week. It's been averaging over the last 3 weeks, call it 34. So it's weekly data. So we try not to get, too worked up over weekly data, but we're extrapolating that and know that our weekly data series on those 3 states and those MSAs have been over 90% historically correlated to the new home market. And we follow the publicly traded home builders that account for nearly 50% of the new home market. And we also survey about 20% of the new home market through a proprietary survey network of C-suite home building executives. So we really have our pulse on the market, but you can really see, George, significant differences in can rates. So anecdotally, yesterday we hosted several executives on what we call a spotlight call for institutional clients to discuss specifically the Phoenix market, which is the epicenter of everything, the boom bust market, and where we see the most non-primary demand that's been surging that we can get into. And the builder on our call just threw out that its can rate was 45%, and acting as if that wasn't the end of the world. And I talked to a builder in Orlando yesterday. His can rate was 55%, but he's like, well, it was really our doing because we were canceling people, so self-induced. So it's changing rapidly. And
Ivy, you got to write a piece if you want. I'll come. I like to turn the table over and cause trouble. I think this is redefining the term cancel culture. I've never heard this. This trumps anything else I've heard. Ivy, let me ask you a question. In your experience, have you ever seen numbers this high?
We did during the great financial crisis. I think that you were seeing, cans probably even exceeding the current aggregate numbers we've seen. And I think that what we have to appreciate is that a lot of the backlog is also speculative. If we're focused just on new home single family right now, as we not only have, builders that were shifting from a build to order model because of their inability to capture the rising costs of materials and labor, and risking that by the time they completed the home, and typically 75 to call it 120 days, and it's at 200 days, their costs could be up 20% from where they signed a contract. We saw a big shift to builders just going and starting homes speculatively and releasing those homes closer to framing, or when they were installing cabinets to mitigate that squeeze on margin. So you do see a big difference between where margins are for the build to order builders that stayed with that model versus those that are doing more speculative building. But I'd say the backlog, which is at the highest levels for single family since 2006, is probably a third to maybe 40% speculative, which also includes the most popular, sexiest, prettiest girl at the dance, the built for speculative product that's blanketing tertiary markets in a highly concentrated way in the Smile States.
So let's go down that rabbit hole a little bit, and then we'll come back up. And we've got some really smart listeners in the room. I hope Jackson comes up because he's all over this. So you were talking about build to rent. There's also, cycles don't repeat, but they rhyme. So you got build to rent. You have the institutionalization of the market with a lot of financial players, the Blackstones of the world. You have Airbnb, and some would suggest that that's hidden inventory, and that will come back on the market, when prices go the wrong way. So how do you think about, and Jackson will weigh in. In fact, you know what? I'm just going to stop right here because Jackson's here. Usually we hold the questions, but he knows far more. I've learned so much from Jackson. And so my general question is this, but then Jackson, before Ivy speaks, maybe you can pile on. I listen to Jackson and I hear about the Airbnbs and the build to rent and all this other stuff. It kind of suggested, okay, we don't have the excess in mortgage-backed securities finance market we had in 08, but we got this different problem. So I don't know, Jackson, how do you want to put the question? Or did I channel my inner Jackson reasonably well, Jackson? Jackson, speak up, please.
You channeled it fairly well. I just wanted to piggyback on what all is being said here. Ivy, grateful to have you here. A little bit about my background.
Nice to meet you.
You too. I worked with LaFrac, and now I'm with Starwood. Anyway, long story short, I'm just seeing all this. I want to ask you really quick, if we may start here. I think the supply numbers are so distorted because of this speculative behavior that we've talked about, and the monkey see, monkey do is the term I use. Everybody became a flipper. Everybody became a home improvement. Everybody bought an NOO. And I know that I've been working a little bit with Taylor Marr from Redfin, because I'm really trying to get that NOO data rock solid. And I know it's really hard to find. I know the Airbnbs, Verbos, etc. aren't the biggest piece, but with rents spiking the way they did, it just became such a speculative move. I think the supply narrative is wrong because the supply number is distorted by the speculation. Any thoughts on that?
Absolutely. I think that we've been, highly focused on the demand side and seeing, cash purchases according to the NAR in the first quarter were up year over year. Oh, this is a 2-year change, sorry, up 46%, whereas mortgage closings were down 1. And if you look at the fourth quarter, year over year, up 43% for cash purchases and 13% for mortgage purchase, just to give you the perspective. But what we've also looked at through public record data, as well as just CoreLogic information that we're aggregating from them and partnering with them, the non-primary, which is what we call it, Jackson, and we think about non-primary for those that might not appreciate what that includes: second home buyers, private investors, institutional investors, and the institutional investors could also incorporate what we call the intermediaries, liquidity providers, iBuyers. So there's been tremendous speculation in aggregate. That number, for the latest sort of first Q, we don't have 2Q yet, aggregated to about 24% of transactions. And we think that's even understating it, because we really can't determine, again, how much of what people claim they're buying might be used for primary. But what we know is that that number was running at about 20% prior to COVID, even 19%. So just the rate of change nationally. And I think you really have to focus, Jackson, in on the, hottest markets. The industry tends to operate more like sheep. They all follow one another. And is it a surprise that Austin has got a very strong job market, that all, the capital goes to Austin? So they kind of follow the same pattern of where they're going. But the private investors, speculating significantly in markets like Boise or in Montana, or pick a market, Phoenix, anywhere they think they're going to make a quick flip. Those are the ones that are canceling too. Because when I was chatting with a builder in Boise and home prices are up 70%, and they're like, "Oh yeah, we're seeing price cuts, we're seeing incentives, we're seeing huge cancellations." And I said, "So when people are canceling, are they saying why?" And this builder said, "Oh, they're just the investors that realize home prices have peaked." Or chatting with a data provider about Phoenix, they're saying that listings in the last, just in Phoenix as an example, in the last 15 weeks are up 220%, admittedly off a record low. But just to put that in perspective, if normalized listings in the MSA for Greater Phoenix would be 25,000, we went from 8, whatever, take the 5, 6,000, whatever the number is now, in the 16, 17,000. They're adding 1,000 a week of new listings. And what they were saying is that they're coming, interestingly, from the deep pocket, wealthiest investors that are acting like they're distressed, and they're a stampede for the exits, which include the private investors that might own 15 houses, and they want to sell 13 because they want to retain 2, but they want to monetize, and the costs have gone up a lot of owning these properties. So I think it's a lot more prevalent than the market appreciates. But then you have to contrast that with markets where maybe in Atlanta or in Huntsville, Alabama, it may not be as prevalent, and the markets are not seeing the same rate, or in Raleigh or Charlotte are not seeing the same rate of deterioration, but you're still seeing very weak demand and seasonally worse than normal activity, and increasing cans. So, but the severity is much, it varies very significantly, is the way I'd frame it. And I do think the non-primary is a big factor.
Jackson, why don't you have a follow-up? Otherwise, I'm going to go to Michael. Michael has some insights as well. But Jackson, I really want you to run with it, because you've taught us so much about real estate over the last few months.
Just a brief follow-up, and I just wanted to see if Ivy's on the same page as me, because one of the arguments I've been making internally and also in these rooms and with other people is, I don't care if, because everybody continues to use the excuse, the Blackstones, us, the BlackRocks, etc. It doesn't matter if it's the big guys. It was still speculative, which skewed the supply that everybody continues to harp on. But I'm with you 100% on that. The demand was never really there. because it became such a speculative boom. And I do feel like the regional's starting to finally bleed into the national perspective.
No, and thinking again, the real time, transparent information that consumers are, privy to, the speed and the severity of the rate of change is just exponentially worse than what we saw in the great financial crisis, because that was a slow bleed. So we're just shocked on the rate of change. And, we do these surveys and we're just hitting record rate of change on our metrics for many of the various metrics that we're tracking. So, people say, where are you? And, in June, it looks a hell of a lot worse than May, and July is again incrementally much worse, at least in the early parts of what we're getting through our conversations, and our Western markets report is deteriorating even further. So the rapid pace of it is really coming, we think, from those non-primary sellers now. And, we are seeing with backlogs so high and the appetite, interestingly, from at least so far, from the build for rent capital providers is not really changing very much. And the builders are shifting, interestingly, from maybe selling. We have some builders that have been selling on a programmatic basis to build for rent operators as high as 25% of what they are building and developing. And others will say, oh, I only do like 3%. And the more of them within, markets now that are realizing they have backlog that is speculative backlog, they're going to need these build for rent operators. So they're now willing to partner more with them. And from what we're hearing, their appetite has not abated yet. I mean, Starwood's out trying to sell 3,000 units in a portfolio right now. And people are like, do you think that others are going to follow suit? I think that the risk is that what we're seeing right now, especially iBuyers, they're, at least according to the contacts that we have in Phoenix, they're the biggest sellers in the market right now at rates that they, are just shocked by, and how quickly these iBuyers are trying to exit their positions, as well as, again, the private investors that might have been the Airbnbs that you referred to. So, we're just sort of now digesting and aggregating weekly what we're seeing, because it's changing so rapidly.
So if I could just jump in, and I'll go to Michael in a second. I was just listening to you talk, and Jackson, great questions. One of my pet peeves has been, I think Julian Brigden coined the term, the excessive hyper-financialization of the economy. It's so much money's been put in the system. Too much monetary stimulus, too much fiscal stimulus. We had the everything bubble. Equities, bonds, commodities, real estate, baseball cards, collectibles, you name it. And the listening to you speak, it's not just institutionalization of the asset of housing, but also, as you were saying earlier this morning, the speed with which the information passes, the internet and everything else. It's really scary to listen to you describe this. I mean, when you say 24% of the market's non-primary, that's just a staggering number. Jackson, from where you sit, when you look at what your firm is doing or other firms, you think a lot of people are or will be soon trying to head for the exit at the same time, Jackson?
I do. Ivy's familiar with Barry's work and our work, and we're trying to get ahead of this thing, because it has just became so speculative. So, I don't know. I mean, people are hanging on. I was gonna use one anecdote, and then I'll drop down and let everybody else speak. But I wanted to share with Ivy. We were in Lexington, Kentucky recently, and just talking to people in that community, how everyone piled in late 2020 to 2021 to be a bourbon Airbnb or a Verbo or horse trot, etc. And they pushed all the residents out, and now the residents are coming back because these guys are trying to get off the lily pad, so to speak. So,
well, I find when I hear those anecdotes, it's more that they're willing to admit it now. But when you're chatting with them while it's going on, no, we're not really seeing much in the non-primary. These are true buyers. Maybe it's a co-primary or they're second home buyers, But, especially when you look at the, rate of growth in the Florida MSAs and the migration, the great migration that we've seen. We've had migration for decades now from high cost states to low cost states, but there's been no question a complacency about it and the sustainability of it. But the local buyers have been shut out, and affordability has made it almost virtually impossible for them to live, especially in resort areas. And you hear stories of restaurants that are, only allowing, availability in certain hours, or portions of the restaurants are not even open or even closed altogether. And it's just they don't have the staff, and a lot of it is they can't get the local labor because they have nowhere to live, or they're living in their car, or they're commuting. And so I think that's a crisis that we have. And today's buyers, I was talking to a builder in San Antonio, and he's like, there's no one that can afford the homes here. The local buyers, are just, without them, and without the residents that typically would drive a market, you now have the exit doors being flooded with the non-primary. We've got directionally supply rising and demand just plummeting in many of these markets. So pricing is headed lower. In some markets, it could be substantial correction. Nationally, we're looking for home prices, to decline sort of 4% in 2023, and I think 3% in 24 for new home, and 4 and 5% for existing. And I think that, just to give you a national perspective, that doesn't seem very much. But when you go into more of the regional markets, I think you're going to see that your double-digit declines are going to happen, and they're going to probably be more severe than even we're thinking, just because of the rate of change and the amount of supply that's entering the market, and people are running for the exits. And they've made a tremendous amount of money, and that's always, when you compare to the GFC, and you think about where we are with risk associated with overall impairments and the kind of downturn experience, people have made the $5 trillion in home equity appreciation. But we did have that in the last downturn too. We just didn't have any skin in the game like we do today. And that might be a bit of a buffer, but I don't think it mitigates the price pressure we're going to feel.
Wow.
Hey,
Yeah,
George, can I go? Yeah.
buddies. Yep.
Thanks. Hi, Ivy. Nice to meet you.
Nice to meet you.
Excuse me. I had two questions. I run spaces in the evening when George is sleeping, and we have a gentleman. It's two questions. We have a gentleman by the name of Logan Motoshami who's out in Irvine, California. I don't know if you're familiar with him or not. He seems to be fairly well published, and West Coast, obviously. But he keeps going on and on and on about how the housing market is savagely unhealthy and this and that. And his sort of God particle for it getting back to normal is the number of listings. And he's saying that until we get to a range of about 1.7 million to 1.9 million available homes in the MLS listed, we're going to have this sort of imbalance in the marketplace. I have one other question. I'm just curious what your thoughts are on that analysis.
Well, I think that right now we look at inventories, which, in a ratio, and I think George has a slide, which I think that the market is utilizing as sort of a great buffer to not be concerned about the risks associated with price pressure, because inventories are at record lows. And we look at inventories, new and existing single family inventories, as a percent of households. And that is currently, at least in the last first quarter data, still showing pretty much at record lows. But the increasing inventory levels that we predict by the end of this year would put us slightly below what would be historically a trend line. So currently, we're running, at, call it, 0.6% of households or something like that. Was March. But let's just say that we're, historically a 2% number, we think that number by the end of the year could be closer to like 1.6 to 1.7 as a percent of households, and 2% historically has been trend line. But it's not about the absolute level of inventory, it's the rate of change and where is demand. So we look at velocity, and velocity is sharply under pressure. And velocity historically, and defining that for the listeners, how we define it is at the end of any month, how many homes are available for sale, and then in the subsequent 30 days, how much of that inventory is sold. And historically, that's run about 20+% velocity. We got in this cycle, our velocity hit almost 60%. So there was so much demand that everyone was focused, well, there's no inventory, but we tripled the velocity from historical levels. And that in itself is where we should be focused, because it's not just where inventories are going, to your friend's analysis, who I don't know, it's what is demand doing. So you got to shift the narrative. And when you look at the new listings that were entering the market during COVID, pre-COVID, we've been in an upward trajectory all throughout, basically first quarter of 13. It's just been an upward trend. And that pretty much continued during, the last 2 years, with the exception of the shutdown in 2Q of 20. So inventories have been rising, but that demand surge was so exponentially overwhelming that's what took inventories lower. So that we've got to flip the narrative. The media is now going to focus on demand and not supply, because they're going to see that the supply is changing so rapidly because demand is weakening so rapidly.
Yeah, so I don't know if you can see it, but for everyone in the room, if you look up at the nest up at the top, I put your slide 26 from your deck, inventories, a percentage of households, is what you were talking about. It's down to, what was it? I know it's a little bit.
It's hard to read. It's under 1%.
It's under 1%.
0.8, right?
Yeah,
0.6.
Average looks like it's 2+ or something like that.
Yeah.
So that's what you're talking about. Okay,
Correct.
that's great. Okay, so let's Aces.
George, can I just have one more question real quick?
Yeah, sure. But I want to go to Michael, who's a builder. So yeah,
you want to go to Michael first?
No, get your question, and then we're going to Michael. Go ahead.
Okay, thank you. So Ivy, one last question. So in my evening spaces, I've had a number of mortgage servicers who have come in, who have what sounds like material numbers of mortgages, hundreds of thousands of mortgages that they service, business owners. And what they're saying to me is that they have over 10% of the mortgages that they service are in delinquencies, but anybody who uses the C word gets put in some kind of a program or something like that. Do you think there could be significant amounts of shadow inventory coming available as some of these moratoriums and programs in these different states and so on and so forth for folks who have been negatively impacted by COVID?
I think that our view is that if we're going to have, to George's opening comment point about people have to lose their jobs to, mitigate inflation or reduce inflation, I definitely think we're going to have people that are in distress, especially those that are FHA, VA buyers, more FHA, that are putting only down 3.5% and, are out of the box unless you get home price inflation. Anyone who purchased really anytime from, call it the end of 21 to now, is probably, if they're FHA, they're underwater just because the transaction costs to complete a sale. So you're going to see people lose their jobs or going to lose their homes. Now, the magnitude of that, with forbearance still prevalent and people that are still struggling, really hasn't normalized completely yet. I think the number of people that were still in forbearance was, peaked at over 4 million, and now we're under 1 million. So, that coupled with eviction filings are so well below normal. And we look at the eviction filings and we're like, holy shit, if this thing normalizes, excuse the language, you're going to see a lot of people that are going to lose, they're going to be evicted. And then you've got landlords that have empty houses. And where are all the bodies going to come from? Because there's a tremendous amount of upward pressure that we anticipate that will push vacancies higher in the face of a backlog, at least, that's at, the highest that we've seen in decades when you combine multifamily and single family. And I think there's a lot of complacency about the rental market because people are like, well, people can't afford it, so they're just gonna rent. And whether it's going to rent a single family home or they're going to, rent a multifamily unit. And in reality, a lot of people that are sellers, because we asked, like in Phoenix, who are the people that are selling right now? And we had a broker on who's more focused, his niche is more on the more affluent buyers and affluent sellers. And they said, well, a lot of them are selling, they're going to go rent because they want to monetize and they don't want to carry the house anymore. And so there's this, perception that we're going to be okay because, people are just, the rental market's going to be fine. But our view is that you've got, backlog and pressure brewing because landlords are part of who are listing to sell right now. The people that speculate and own 15 houses, or the institutional investors that, are at a stampede for the exit doors. I think we're going to see a lot more pressure, and that's not even including the risk of a recession and job loss destruction. So I think it's going to get worse, and people are not really thinking about that when they're looking at, like I had a builder call me yesterday from Sacramento, says, when is this going to end? Like, how long are we going to, be dealing with this? And I think that, anything that goes up in the euphoric straight line that housing went up is not sustainable. And, they're feeling, a lot of the industry executives is like, well, we're kind of back at 19 levels. So it's not so bad, where we were in terms of volume. We're just seeing volumes return to more normalized levels where we were pre-COVID. But, are you stopping the clock right now? Because things are not stopping. And I think that people are really looking at, where the demand will come from. We believe that housing is more balanced if you exclude what's coming in backlog with respect to household, the normalized level of supply that's really consists of incremental household growth, plus the need for demolition, replacements of demolition, and then sort of a normalized excess inventory. We think we're more in balance, and the market thinks there's this massive deficit that we just don't believe exists based on our demographic work. So we think there's going to be a problem, not just in single family and possibly, distressed sellers, where you, again, on the margin of coming again from that first time buyer predominantly, but also from landlords that are going to lose bodies because people are going to be evicted, and it's going to be hard because the rents that they're charging are exuberant right now. They got really egregious with rent increases.
It's like the more you drill down, the further you go down the rabbit hole, it's like the more I'm kind of like, oh no. I mean, I kind of came in with a negative bias before listening to you talk. You're just making it worse.
Take a look at slide 59, George, if you want to share this one.
Yeah, I'll be sure to put that up. All right. While I'm trying to fish for that, I want to turn to Michael. Michael is a friend of the room. Michael, I've not revealed to the audience some of the communications that you've sent me. I know you're in the Federal Witness Protection Program. So, Michael, I don't know how much you want to talk about what you do, who you are, where you are, but welcome, Michael. You're a wealth of information. So please unmute yourself, Michael. The floor is yours.
Hey, George. Thanks. Well, what Ivy just said was pretty much everything that we are seeing in the Boise area. And we're not a builder. We're just a general contractor. And we are one of those speculators that flip houses, and we do client remodels. And we're seeing it move pretty quickly here. That's not necessarily being reflected in like the actual average price of homes sold, but currently, about 30% of all the inventory is getting price cuts, and that is ranging anywhere from 2 to about 10%. And if they're trying to move that inventory, it's closer to about around 15%. And then Ivy, thanks for everything you have provided to the space. It's kind of blowing my mind, to be honest with you. It's quite a bit worse than what I was thinking.
Well, Michael, given you're, obviously in the thick of it, I like to refer to you as boots on the ground. I think Boise's home price appreciation over, 2-year period was up north more than 70%. And, what, you've seen is a tremendous amount of influx of your people from California and Washington State, and, pretty much the arbitrage that was existed, kind of got arbitraged away. But when I talk to local builders in Boise, what I hear is that a lot of people are being told they have to come back to work. They're now being asked to return and be at work 3 days a week So people that have relocated or thought they had the flexibility, maybe some of it's also being driven in terms of why remote work, which I know George we wanted to talk to, but it's also the flippers and in Boise where you've made that much money and people are now like, holy shit, the market's peaked. I want out. The builders are having to move inventory. And the worst thing is, builders can do is actually cut price because then it affects the backlog. And then you spook your backlog if they see these ads. And I just remember looking at an ad for Pulte that I think might have been, I don't remember which Southwestern market it was in. It wasn't Phoenix. It might have been in Dallas. They cut price, literally slashed through the price on, and we track all of their websites get Google alerts, watching every incentive that they have published or on their website. And it was a 7% cut in price. So you think if you're a consumer, you signed a contract and you're watching their website, you're like, what? They're getting a better price than I did?
Right.
I don't want this house anymore. And, depending on when you bought it, you might have a lot of embedded equity. And my senior analyst, been with me 17 years, he's like, I think a lot of people we won't see cans surge as much as maybe we've seen in the past because of the embedded equity. But when you think about the last 6 months, none of those people are sitting on a tremendous amount of equity. So there is a view that this will diminish because those that are still up massively are going to continue to hold, their contracts and wait for their homes to be completed. But I think that we've got some dynamics again with remote work. The changing environment of remote work might also be a factor in how this plays out.
Yeah, I totally agree. And what we're seeing as well is builders actually giving closing contributions to buy down rates, which is probably suppressing the actual reported sales value.
Right, and they do that all the time.
Well.
The lenders right now, Lennar is offering right now, if you close by X date, you can get a 4.56% 30-year fixed rate. And
right.
That if that doesn't stimulate, demand, to me, when people say, when you call the bottom, and we called the bottom in 2012, it was not one factor because affordability at that, even 2009, 10, 11 was close to record levels of affordability. But the consumer was still fearful as home prices were declining.
Right.
And so when the consumer now thinks home prices have peaked, it's like this massive container, ship, oceanic container, that freight. Once it changes directions, then you just have this sentiment shift. Like you haven't gone to a cocktail party or a barbecue or hung out with people and friends and people, I'm buying a home, I'm moving, that changes. Now all of a sudden I'm a seller, I'm getting out. And I think so much of this is going to be magnified by the sentiment that consumers are really the last asset. Let me monetize before this economy rolls over. And you're watching the wealth destruction of the stock market, the crypto market. And, Resi's still the prettiest girl at the dance or the tallest midget. And so the people, I need to get my money out. I want my money back. And so I think you're seeing that. And it could be, again, primary sellers that are going to a rental unit, and that might help the rental market in the short term. I do think it will help the single family rental market relative to otherwise what demand would have been. But, to me, when you think about homeowners in the United States, thanks to terrible policy by the Fed, keeping rates at, record lows for as long as they did and being accommodating, we now have the backlash in the mortgage industry of so many homeowners that actually are locked in below 5%. Over 90% of today's homeowners with a mortgage are locked in below 5, and almost half are locked in below 3.5. So you just think about primary sellers; they're not likely to be the demand destruction won't be coming from them as much as it those that have to sell. The 3 Ds:
right.
death, divorce, default. But then you also have, I don't have a D for speculators, but it's the discretionary sellers that I think are really going to be the driving force of the market.
That's great, Ivy. Hey, Michael. Michael, let me ask you a question. I'm not putting you on the spot asking about yourself, but when you look at other builders, flippers in the market where you are in Boise, and you're talking about the intensification of price cuts, usually what happens this point in the cycle, you get some people get caught, they're long, whatever, and they get caught and they get flushed down the toilet. Do you sense an increasing amount of stress amongst some of the less well capitalized builders in the Boise market?
Yeah, I mean, sentiment has definitely changed with builders, developers, residential owners. Kind of to Ivy's point, we all knew it was crazy. It's not like we thought property value should be going up 200% over a couple year period. But now with the current macro environment, people are definitely getting more scared. The question is, how leveraged were those buyers? Because they're coming in buying these plots of land quite a bit of ways from the actual city of Boise. From anywhere between a couple $1 million and up to $25 million to develop subs that would have 500 homes in it. And we're talking about these cities that growing up I would never go to because it was just farmland. And so it'll be interesting to see how they actually get caught holding that land or in the early phases of those developments.
Michael, it's interesting because we have a land development survey that we do quarterly that we're tracking north of 15 billion of assets through these land developers. And one of the things that we've been very concerned about and people have been more complacent about is the lot inflation. So when you look at overall land inflation pre-COVID, and I have a chart that shows the surge, like all of our charts, chart busters, where you're seeing the accumulation not only of lots that the public's own on balance sheet and the surge there, but the level of inflation, just 1Q over 1Q22 was still up 28%. And when I hear, builders' appetite for land is now diminishing and they might be pulling back, but others are still in the market and they're looking at underwriting, to try to now underwrite to a 20% gross margin as opposed to the gross margins that are in the 30% range. And so what you hear for the spec builders, well, I have 30% gross margins. I got a lot of cush. I can reduce, overall pricing net, using incentive, commonly financial type buy downs or closing costs and, backdoor incentives. And I could still, maybe my margins will go down to 25, but I'm still, got a lot of room to go. And our view is that they're assuming sort of right now the market stays the way it is, but all the land that they have acquired, and a lot of that through options, those that are, especially the publics that have tried to do off balance sheet, we think there'll be a lot of option abandonments, but the publics are in good shape, at least the nationals are 50% of the market because their balance sheets are in the best shape they've ever been in. But there's no question, especially some of the new entrants that have never gone through a home building cycle that paid up for these land. Those land developers, would talk to us and be like 40% of the surge in land prices, which are probably up, 50, 60% on a 2-year basis in markets, some markets double, up more than 100%, especially out west in terms of those southwestern markets and Arizona and, Idaho. You would know better than me there, but they're just kind of like, well, I've got a lot of equity in my land, so I'm not really worried about it. And we don't know how they're financed if they're private. And, a lot of times the privates are a little bit more conservative at times, the ones that are decent size. But there's a lot of new entrants to the market that we don't know that they really understand and appreciate, the cyclical risk. And they were the ones paying up. 40% of the land surge came from non-production home building purchasers. So the build for rent operators were predominantly and the build for rent market. We've been, for us that are old enough to remember the movie, all the president or the presidents with Nixon, all the President's Men. Yep. What's called? Yep. My title might be off, but we've been following the money and tracking through the last few years every public announcement for build for rent and where their communities are opened, if they disclose it, where the markets they're in. And it may not sound like a big number, but that number is tracking now, and it's predominantly unlevered, 95 billion, but only about 25% of it has actually been deployed. And I think that where it gets more risky is that their built for rent product in many cases is a homogeneous product to the for sale product in a new home development, and included all of the bells and whistles that a new home might have. Maybe some of it's stripped down depending on the builder, but like Lennar, for example, will sell the same exact house or will rent out the same exact house that they're selling. The monthly payment is higher in most cases on a per square foot basis for the rental than it is for the for sale product. And they're concentrated. We created an index, a GDI, we call it, geodynamic index, that looks at micro markets, thousands of zip codes of where there's available product for sale communities and for lease. And when you look at where the concentration of built for rent is, no surprise, Smile States, biggest one being Phoenix. 20% of all built for rent starts are in Phoenix. We've got the Texas market, the Carolinas, and they have to go drive to the tertiary markets to buy land so they can pencil it, both production builders and built for rent operators. But over half of what's available through lease or for sale is on 100 on our GDI index is New York City. And we're looking at, densely populated market. 0, I joke, where the cows don't want to even live. And you're out in the third ring of the market, tertiary market. And that over 50% of what's being offered is below 10 on our index in both rental and in for sale. So not only is it concentrated in the Smile States and, in many of these boom bust markets that have had the biggest cyclical, surges and troughs, but they're now concentrated in those out exurb markets. And so it really is, we question, where are these bodies going to come from, especially as you go closer in and there might be more opportunities as you see pressure closer to job centers. And everyone didn't care because they're going to build where the cows don't want to live, because guess what? People can work anywhere. Oh, well, wait a minute, gas prices are up a lot. Well, it doesn't matter. I think it's, even the contractors don't mind being, they're the contractors and all the construction industry. They'd rather be in those tertiary markets because that's where they're working and that's where they live. And so I just think that's a recipe of real risk for the amount of homes that might be sitting empty. I'm not suggesting ghost towns like we saw, in many of the inland markets in California and Arizona, but we're going to have a lot more supply getting delivered that's speculative. All the built for rent is 100% speculative, but then you get the for sale speculation. It's just going to be very difficult to absorb all of that when affordability is so stretched. And, the optimism, and George, I want everyone in the space to weigh in, is, well, rates are going to come down and housing is going to be the winner. Consumers' demand is going to surge again because, the yield curves, and everyone's convinced that you buy the long end of the curve right now because there's going to be pressure, and housing therefore is, I had clients emailing me yesterday, time to buy the builders. And I'm like, nope.
Got it. So Ivy, that's fantastic. Let's just reset the room here for a second. So we're speaking with Ivy Zelman of Zelman Associates. She's the number one housing analyst in the country, and I don't know. The more she talks, the more depressed I become, as if that's a possible thing. At any rate, we've got a great room here going.
Sorry, George.
So we had Jackson and then Michael, 3 aces. So we've got a couple really great cookies, smart cookies, up next. So Ivy, we're gonna have Abe, and then we're gonna have Kevin. So Abe is in Toronto. Abe, one of the few markets that's crazier than the U.S. Abe, just a warning up front. Ivy doesn't really follow the Canadian market, so it'd be great if you want to compare and contrast what's going on, but don't. Canada's is not. She doesn't follow it accurately. So Abe, Abe's one of the sharpest guys in the room. So Abe, good to see you. The floor is yours.
Thanks very much, George, and Aces and Ivy. It's been an absolute pleasure listening to you today.
Thank you.
I'm an old sort of veteran. I just to provide some context. I spent part of my career in structured finance and securitization in '08. So I saw the whole thing implode right before my eyes. So I've got some context in terms of what happened in '08, both in Canada and the U.S. And sort of fast forward to 2022, I do have a question for you that is more U.S. centric, but here's a comment in terms of what's happening north of the border. I reside in Toronto. Much of what you said in terms of, and again, I'll paraphrase, not wanting to go where the cows, not even the cows want to go. I'll give you a little bit of some real stats surrounding the Toronto city. And by the way, Toronto, if you think things are insane in the U.S., you haven't seen anything. You have to come to Toronto to see a level of insanity that's probably 5 standard deviations from the mean. We have seen, I'll give you an example. Peak was February 2022. We have seen jurisdictions around Toronto, 40 minutes around Toronto, take a $500,000 bloodbath. So I'll give you an example. Median detached sales in Oshawa, which basically, no offense to people who live in Oshawa, but is not exactly where I'd want to live. They're down 33%. Another location, which is Whitby, which is again about 20 minutes, that's down $500,000. The downtown condos in Toronto are about the only thing that's bidding at the moment, but they're completely insane as well, where you're looking at sale price of anywhere between $1,600 and $2,000 per square foot. The other thing I'll mention is that you mentioned something that's really, really interesting and something I've been talking about forever, and it's just been ignored. In Canada, and I think much of what you guys are going to see now in the States, is that we've had a demand problem. We do not have a supply problem. We have 332,000 housing starts per year, but the problem is that the financialization of the asset class has become so entrenched that we have a massive demand problem. We also have immigration policy that's been used as a tool in order to keep pricing, keep a floor on pricing. And actually, that will be my question for you in about a second or so. So what we're seeing here in Canada is essentially a situation where we have an asset class that is dominant, which is basically housing. We're now seeing large developers, condo developers that are shelving projects one after the other. Within 2 weeks, we've had 5,000 condos that have basically been shelved. I have access to about 2 of the largest builders on a personal level. They're essentially shelving deals, putting them on ice. The level of inflationary inputs to construction are absolutely obscene. Can't find people, skills gaps. Now we have the pressure with regards to we've had the Bank of Canada raise their rates 100 basis points, which has been the most in 24 years. So it's a bit of a shock to the system. Another thing that came up, I think 3 Aces asked me this: 53% of the total mortgages that are outstanding are variable rate mortgages at the moment. Our longest term typically 10 to 5 years. You can go to a 7, but 7 years are very cost prohibitive. So we do not have 30-year mortgages in this country. They're basically 5 years and they're variables, and 53% are variable floating. So good luck to them. The only thing that's kept the story alive in Canada, and this is your question now, it's going to be coming, is we have seen the influx of foreign buyers en masse that has been so unprecedented that they have essentially moved the needle in terms of both on the supply side, but also keeping a floor on price. And it will be questionable as to whether or not that shall continue. And the question that I have for you, which is more U.S. centric, is what are you seeing, if any, foreign capital inflows into major cities, major U.S. cities that have more of an international flavor, like, for example, New York, could be Los Angeles, it could be Boston, etc. Are you seeing demand being crimped, and how do you measure the foreign flows that actually end up in these jurisdictions from a foreign buyer perspective? Thank you so much. It's been great.
Well, no, thank you. It's really interesting to hear about the Canadian market. I actually analyzed the Canadian market probably 7 years ago when Taylor Morrison was a developer builder there, and learned a little bit about the Greater Toronto area and the limitations there. And really, the predominant difference was the lack of a 30-year fixed mortgage, and people would really hold that as the big differentiator. But Taylor Morrison sold their operations because they didn't want Canadian exposure, because the U.S. investors didn't like them having presence there. But when you think about foreign investors, the best way for us to track that is through our real estate broker survey. So we're surveying independent broker owners that are franchise owners that in aggregate sample size is north of 10% of existing home sales. So every month we ask them where foreign demand is. And we do it on a 0 to 100 scale. And the numbers have remained very low relative to any historical perspective, because we had an influx of foreign buyers that drove, New York City prices back in the early part of the recovery in 2014. New York real estate prices peaked for 4 million plus. As we saw a lot of those foreign buyers exit the market. And New York is probably still below the 14 peak right now in New York City. We've not seen the influx yet. There's a little bit on the margin, but very little that's offsetting the domestic activity that we're seeing. But it's what we try tracking it through the broker survey. And there's public record data, and the NAR puts out numbers, but very lagging and really not anything real time as much as I think our broker survey reflects.
Great. Thank you so much.
Thank you.
I would just observe also with the dollar being so strong.
Right.
It's not that I don't think foreigners are going to have an appetite for buying for that number going up anytime soon. So okay, let's move on. We got a couple others.
I wanted to bring up, George,
Sorry.
if I could.
Go ahead.
I wanted to make sure I mentioned it because thinking about the cost and inflation in materials and labor and all the inputs and development costs, roads and pipes, it's so inflationary that a lot of deals just don't pencil now. And chatting with some of the largest developers / institutional owners, the backlog that we cite for multifamily, as just to give you an example, in condo and high rise or just suburban, podium, their view is that, a lot of the backlog that today is at the highest levels since the early 70s and hitting in backlog for us, they've broken ground. They've started the project as opposed to just pulling permits. And what we've heard from industry executives that we're aggregating almost 2 million units monthly, that we're assessing what they're seeing, including development. They're basically, once they've broken ground, they're moving forward. They're going to monetize. So you mentioned deals getting shelved. I think that is typically, and correct me if I'm wrong, is if they haven't broken ground yet. But we believe that 23 and 24, we will still see that backlog getting delivered in multifamily that will pressure lease rates, and many are more complacent about it because they'll think those number of units in backlog will get canceled. And on the multifamily side, we are seeing starts plummet, meaning new incremental permits being pulled and starts, and that's where the disconnect comes from, because there's complacency around backlog, assuming that backlog is now going to be shelved. And over 90% of our industry contacts said, no, once we've started the project, we're going to finish it. So I don't know if that's the same in Canada or not.
Yeah. So just as a point of clarity, we are actually seeing projects actually being canceled. They're just altogether essentially saying we're not going to go through with it during the permitting process, and they're looking at a later date. The other issue that they're having here is that prices have plummeted, and as a consequence, they can't make the numbers work. And as essentially saying there's no juice here, so we're out. Could be indefinitely, but for the at least for the foreseeable future, because the whole condo development is, as it's several years. It's 2 years just to get approvals here in Toronto before you can even stick a shovel in the ground, and then you've got a couple of more years. So we're seeing that and repricing. is actually what's happening. The problem is there's no takers.
Mm-hmm.
So, it's like, we're not going to shelve, but we still want this, but the market is saying something else. And so as a consequence, they're being forced to shelve.
Well, we have our transaction and operating survey for the multifamily industry, and cap rates are expanding, but we're in price discovery mode. Like there's, for every project that's put out there where there were, 20 bidders, there's like crickets now. And so the market hasn't even figured out from a transaction perspective how much weakness there is. But you're absolutely correct, and deals are not penciling. And once they've been permitted, but if the shovel's been in the ground, they're going to move forward, and that's where the risk comes from. Yeah,
the same thing here. They have to go forward. There's no question. They've been financed, so they are moving forward. It's just a question of what's going to happen.
What are the returns going to look like? That's
exactly
the problem. Mm-hmm.
Exactly.
Right. Thanks for that, Abe. Abe, stay there because I'm sure there'll be more questions. So you can.
Thanks, Abe.
So let's move on. I want to go to Kevin and then Peter. They've been waiting patiently. Kevin, welcome. Please unmute yourself, and then Peter, you're on deck.
Hey, thanks so much. Great to be here, and thanks for all you do, Ivy. I've been following Ivy for 20 years in the industry, and she's always been a hero of mine because she tells the truth, no matter how unpopular that may be. First thing, I just always be careful what you wish for. The Fed wished for inflation forever. They got it, and now I hope they're truly wanting to take advantage of that. And now a lot of people keep talking about that we'll go away from a savagely unhealthy housing market to a healthy one when we get the inventory. And I think it's somewhat similar in that be really careful what you wish for, because those of us who went through the GFC in this industry know that supply and demand always has those two parts to it, and one doesn't solve the other on its own. Ivy, I just wanted to say a quick example of a builder we work with in Austin, Texas, who in June, they have 300 homes under construction, all past framing. Offered 3.875 interest rates, offered up to $170,000 off the price of a home, 5% bonus to buyer's agents. Basically anything that a salesperson selling new homes would ask for to overcome objections. At the end of that, then they spend an extra $100,000 telling their marketplace, radio, television, billboards about this fantastic offering that they have. And out of those 300 homes under construction, they sold a net of 15.
What was, just sorry to interrupt, but can you give us a time frame? Because that 3.75 that you said they're offering them, that's a pretty big buy down, and so pretty shocked to hear that they had that locked up. But
yeah, so that's for the homes under construction. That was June 1st of last month, and so they kitchen sinked it on everything except for base price on new homes, because it's just focused on the inventory. But they kitchen sinked it in June, which June and July typically for home builders are two of the worst months anyway, when we have normal cyclicality. And then the Michigan Consumer Sentiment Index is so poor that the consumers just are not responding. And we work with, for everyone else who doesn't know, we work with 65 different home building organizations around the US. There is no incentive that has meaningfully created sales absorption increases. It's been incremental at best. And so that's what I think is most interesting is, rates popped up and everyone said that's what caused the affordability issue. My sense is still that the price increases, if you could afford a house in March of 2022, you could probably still make the payment with adjustable rate mortgages. You're just choosing not to, because there's no visibility about the future. And so I just think it's interesting. Builders who have done any incentive, it's only been incremental, where they feel like they've been able to sell more homes than they would have without the promotion, but it's not anything that's making them feel confident about the future.
That's not surprising. And it was Peter, is that correct? Kevin. Sorry. So the interesting thing is that it works in certain markets and it's not working in others. And that's where, you're seeing the incentives maybe stimulate demand, but it's still off with respect to normal seasonality. We're definitely seeing weaker demand, but you're seeing some of the activity, especially in the Southeast, actually work. Like, I was surprised on the optimism and what I was hearing in the metrics. So I think Austin and Phoenix and Boise are examples of where markets are really turning, and it doesn't matter. Sentiment's negative, and it doesn't matter.
100%. And I think a
So
lot of that
totally inelastic, and you're not going to see that container shift direction again, and it's going to just get worse. But when you're looking at certain markets, I don't think it's going to last. But right now, they are seeing incentives driving, incremental demand. But absorptions, which is the lingo we use, how many sales per community the builder selling, just to give you some numbers, if you're selling one a week for a month, that's a level of absorption, you're getting price appreciation. And so absorptions peaked and actually exceeded the great financial boom period on a per community basis. They then had to limit sales. And through our survey, at one point, the several hundred builders were aggregating, about 60% were limiting sales in the communities they were offering because they couldn't catch up with all the supply constraints and just the whack-a-mole of getting the homes completed. So they started limiting sales. Now that's fallen to 20% from almost peaking at 60. And the 20% that are still limiting, it's not from demand. It's because they can't keep up. Their backlog is still problematic. They're still trying to get these homes closed. But what we've also seen, just thinking through, all the metrics that we're aggregating, is this just incredible amount of pressure from the builder's perspective on, absorption. So the Western market numbers this Wednesday, today's Thursday. Did I say Wednesday? I don't even know. Thursday. Wednesday, yesterday, it was 0.4 a week in aggregate for the 3 states that I mentioned that we do weekly, just to give you that perspective. So anything below 1, you're typically a week, you're not going to see pricing power. But when you see numbers like 0.25, 0.4, we've seen MSAs at those levels on a per weekly basis, rising cans. These builders are seeing levels that we saw in the GFC in some cases, or right in the heart of COVID when we shut down. So it's not going to last in the markets where we're seeing demand getting somewhat stimulated through incentives, but it's just a pretty remarkable difference by market that we need to make sure we're at least providing you guys insight to. So it's not the same everywhere. Austin and Phoenix are the first to turn, and the magnitude is going to vary, but it'll be interesting to watch how severe the Southeast, if it is severe. But there's more optimism there.
100%. The builders that we work with in that area who have resisted or pushed back against price increases in their supply chain at all are still selling relatively well, but they generally don't even need to use real incentives, or they're not advertising. It's just back pocket negotiation when the consumer comes in. My question for you, though, was, the GFC, as painful as it was, at least gave builders an opportunity to reset land, and ultimately a lot of that fueled the growth and profitability for the next decade. Do you think this round of pain gives us anything different than what that round did, as an opportunity for future optimism once we go through it?
Well, I think that a lot of the builders and institutional investors believe that the magnitude of impairments and equity destruction and the GFC, builders wrote off 50% to 60% of their equity. And because, the public builders are able to reset and basically have the benefit of now, a lower cost basis, it did provide this, window for their trajectory of growth and earnings. The options as a percent of total back in the boom period actually is the same number, 60% roughly. The difference, though, is the size of the projects, and some of those options that we thought were true options were specific performance options where they had to move forward. And there's a lot of land bankers right now that are charging quite a bit for the builders' flexibility of having land off balance sheet. They would tell you that these builders are going to have to perform. So there could be, again, depending on the magnitude, we could see a reset. But the builder's optimism is I have so much land that has seen a surge in appreciation, as I mentioned, with land prices up double in some cases, or 50+%, that all this new land that they've purchased is really where the risk is. So it's a lot of room before they're going to need to take substantial impairments. But we disagree with that. We think we're going to start to see probably about 5-6% of the equity is going to be written off. So it's not going to be the same massive. I mean, in cycles prior to the GFC, that 5-6% is kind of in the range of other cycles, like in the 90-91 cycle. And so that's our starting point, though. I mean, even during the great financial, the GFC, and when we were headed lower, we had like a 20% write-off that we were forecasting, and it wound up being 50 to 60. So the demand side, and how, is a recession going to be a technical recession? Or are we going to have a severe recession? But I think that our starting point is that much more conservative impact to the land and to the equity values for the industry than we saw in the GFC as of today.
Thanks for that, Kevin. Really appreciate it. All right, let's move on to Peter.
Great question, Kevin. Thank you.
Yeah, Peter, floor is yours. Welcome, Peter. What's up?
Hey, what's going on? Sorry, I'll keep it brief. Just something that, just to get into the incentive thing, like I'm a realtor here in the greater Toronto area, and the emails I've been getting from builders on like 5% deposits, 2 years free maintenance, all for condo developments has been pretty nuts lately. They're even doing shuttle buses where they're taking realtors around to sites and shuttling people from spot to spot to even sell projects now. But the one thing I wanted to mention as an anecdote was more for Abe, because he said his note on, or his point on immigration, trying to keep a floor on this. I have been doing in the last 30 to 60 days so many lease listings, more than usual. And I can't tell you the amount of applicants we've been seeing. It's been madness, and rental prices are up probably 20% year over year. But the amount of applicants, I would say 70% of them this is across the entire GTA area, that are either just recently in the country or they're not even here yet and they're looking to lock down a place. It's been insane. Like, I've probably done a dozen of them in the last 30 days.
Wow.
And I would say more than 70% are just like not either, again, here for 2 to 3 months or haven't even shown up into the country. Mostly from India, actually, and they're just being transferred here. That's the predominant of what I'm seeing. But even like families of 3 and 4 settling for 1 bedroom dens and like smaller accommodations. So just a note on that.
That's interesting. Maybe it's Canadians are a little bit more favorable on immigration than our people, our politicians in Washington.
I think
so.
Abe,
hold on. We have a quota on the number of Canadian questions. You Canadian guys are all over the place. The Canadian oil guys, Canadian real estate guys. Enough. Come on. Enough. Seriously. All right. I have a couple more questions for you, and then we may tail off here. We haven't really spoken in great detail. It's an obvious question, but share with us your framework for the way you think about work from home and the permanent impact that's going to have on relative price across markets. So, Captain Obvious, check in. I know you're in the city. I live in Westchester, and you'll correct me. I'm sure I'm going to misstate something, but I've observed that some of the headline numbers you see or the articles I see about what's happening in New York real estate is highly misleading. They'll say, "Oh, New York's coming back. It's great, yada yada." But there's like a shift going on there. People who, an overpricing on the Upper East Side's got no bid. It collapses. So, someone might trade up a little bit. When I look at the per square foot transaction prices, which I think is the right way to look at it, yeah, it's come off the bottom, but as I think you started to say, we said a little while ago, it's not back to where it was a handful of years ago. So you compare and contrast that, and whether New York's down a little bit or a lot or flat with where it was is not the point. The point is it hasn't really been robust compared to, we just heard from our Boise friend and some of these other markets where, Austin, everything's up and to the right, like, it's at a different multiple standard deviations above where it was previously. So how do you think about, with work from home, it's reshaping the footprint where we work, where we play, where we live, where we vacation, et cetera, et cetera, et cetera. So how do you think about to the extent this is a permanent reshuffling of the deck? If you could buy a synthetic, and you may say, well, George, it would have been a good idea 2 or 3 years ago, but not now. Would you, for instance, if Goldman Sachs would issue us a derivative where we could be long Florida versus short New York, like, you think that's a good trade? Or, and some people say, well, Florida real estate's never going to go down. Well, they always say that because
Right.
there's 300,000 people a year leaving New York, elderly people leaving New York to go to Florida, and you just look at the tens of billions of dollars of gross income that's walking out the door from New York every year and going to Florida. So back in New York don't work. Quality of life is getting worse. Blah 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 blah. The whole story. So how do you think? And New York is just probably at the leading edge of all that. It's true across many cities across the country. So how do you think about that in terms of the way when you try to pontificate or scenario build about what relative change in real estate prices are going to look like going forward in the years to come?
It's a great question. If you just look at pre-COVID, the number of households that worked remotely, we were, of the population between the ages of 20 and 64, something was 6 to 7%. And, where that levels out, I've seen numbers where it's even back to those levels. In some articles, it's double those levels. I don't have a good read on, real time what that is, because there's mixed, policy from, management teams where you can come in 3 days, it's hybrid. But I do think that it certainly has helped, the more affordable states, and the arbitrage is massive, or had been, from New York to Florida or New Jersey or even the Midwest, to states like Tennessee and Alabama. I mean, those markets have taken off. But what we look at, George, is really the rate of change going forward, the sustainability of that influx. And is it changing? Is it moderating? Have we sort of run out of gas on that? And while people think that we had the Great American Shuffle is a new thing because of COVID, we would say the Great American Shuffle has been going on for decades. And so we always ask builders, we'd hear management teams on conference calls say, 40, 50% of our buyers are from out of state. And the right question to ask is, well, what was that prior to COVID? And when you ask them, and I don't think they have good data on it, they might say, well, it might have been 20 to 30%. And I have builders yesterday, a builder I spoke to yesterday that told me 70% of his buyers are still coming from out of state, predominantly New York and California. And, it's just a question of, again, the confidence level for people. It might be that they can have the ability to work anywhere, and their company and their employer who wants to retain them is going to be flexible. It's interesting because, my chairman and CEO wants to know what does the Roe versus Wade, reversal mean for where people are going to want to live and work. And Wells Fargo cancels their move to Texas from their headquarters in San Francisco because of Roe versus Wade. And will that, sort of impact, the blue states more favorably? People might want to stay and live and work in those markets. I know it's a lot of, political sort of rational or irrational ways that you think about markets, how they might be impacted. But, it's a new layer that we have to contemplate. Especially it's really about jobs. So if the jobs are moving to these more affordable markets, then you're going to probably see a continuation of, especially as they contemplate, affordability. But I think that people are going to be spooked, George, right now, just because prices in Florida have surged so much that, your price per square foot in Miami is not, it's in parity with New York, on par with New York in some cases. So is the arbitrage still there? And do they feel confident buying at today's prices? I think you need a price correction in Florida. But would you, if you had to say over a 5-10 year period, would you rather be long Florida and short New York? I'd probably have to agree with that.
Yeah, I mean, it was an obvious trade in the aftermath of COVID. Go back to 2Q 2020, but Florida may be sort of like a high multiple growth stock where it's already fully in the price.
Right.
So I'm kind of with you. So
we're just looking at the rate of change and just want to appreciate that. The influx to Texas when you've got 112 degrees and you can't use your AC at full blast. I don't know how many of those now transplanted New Yorkers in Texas are going to want to stay in Texas under that, or just
100%.
the fact that there's
100%.
different state regulations that are impacting how people feel about staying in those states. So I also think remote work is in flux, and whether or not the trend will continue to move back to coming back to the office. I think it's rather unhealthy for young people to not work in an office environment where you have people you collaborate with, you learn from, and can be left behind. So I don't know where that's going, and I'd be curious what you think.
It's interesting. Your alma mater, CS, James Sweeney, who was the economist there for a number of years, he went to I think it was BlackRock recently. He asked a really interesting question. I remember one of the first panels in the wake of the COVID first disaster with COVID in 2Q of 2020. And he was heading a panel, and he asked each of the panelists the following questions. Very good question. What changes are people seeing that most think are permanent, but really will turn out to be temporary? And what changes in economic activity are people seeing that most believe are temporary, but will turn out to be permanent? And if it was just COVID, I agree with you. I think, especially people, and also people in the creative industries, they need to aggregate. There is a network effect. You need a mentor, all that kind of stuff, a cooperative effort. But if you're a lawyer or a portfolio manager and you can work from home and you're further advanced in your career, would you rather be sitting at the beach out in the Hamptons or, in Midtown? And there's a quality of life issue there. And so if it was just COVID, I wouldn't think it's so permanent, but I think there's this technological change which is taking place. We didn't have Zoom 5 years ago, where it's more amenable, lends itself to more decentralized workplace. And so I think, for instance, take Maine. I'm sure Maine is not the hot. You're focused on Phoenix and Austin, okay? I mean, Ivy, I don't even know. I'm sure you have it because you're a housing nerd. I mean, you probably have. I just got to pick on Maine because Maine's totally asleep. Nothing ever happens there. But have you seen what happened to Maine housing prices? Because people they step out of their place in the Upper East Side. And it's go to Maine, you can buy 10. At least you could have 2 years ago. 10 houses for the price of what you own. And people are hey, wait a second. I mean, I don't want to live in Maine because it's cold and there are mosquitoes and the water's, whatever. But, I'm exaggerating, but you get the point. I mean, if you don't, I'll give you another example. I live in Westchester, in one of the more expensive zip codes. And my neighbor was former global strategist for a major bulge bracket firm, lived on the Upper East Side. My neighbor, I said, because this was kind of his little weekend getaway place. So he lived on the Upper East Side, was primary residence. He'd come out here on the weekends because he's got 3 kids. There was a pool, tennis courts, the whole deal. And I don't think he's pulled the trigger on it. But if you're him, do you want to be stuck in a $6 or $7 million place in the Upper East Side where the quality of life of the kids sucks? There's no grass, there's no pool, there's no tennis courts. Or if you only have to be in the office a day a week or a day every 2 weeks, and you can instead hang out in Westport and schlep in an hour and 45 minutes, it's it's not even a question. Of course you do that. Mm-hmm. So I just cut, I don't know where you live in the city. I'm not going to ask you, but I mean, if you go long, short, look within the city, go long, short, Upper East Side, go short, Upper East Side, long the Village, or, I mean, it's just, and I have some friends in the room here. I'm not going to give this person's identity up, but I have firsthand knowledge of this. I mean, I don't know where you are in the city, but it's some of this stuff is, I think it's permanently impaired.
Well, you're not even talking about taxes yet, and what what the impact just from what New York's going to have to do in order to offset the exodus and the revenues that they would typically be generating. It's can be it's frightening when you know too much, as we do, and be an owner of what has been a second home for myself in New York, and thinking about 100%. The same things.
All right. I want to go on to another question, but before we do that, I've been remiss. We're not going to keep you here all day. Ivy, you're free to go whenever you want, but maybe we'll do one or two more questions. But before we do that, if any of you are interested, Ivy, does prodigious work on the housing market, knows this more than anybody, frankly. And there are a lot of really real estate inclined folks in the room. If you're interested in learning more about what she does and maybe becoming a client, it's their website is zelmanassociates.com. And a good friend of mine, Pam, she's head of sales and marketing for Zelman Associates. If you email Pam at zelmanassociates.com, that's Pam at zelmanassociates.com. God, I hate the way I say it. Sounds like I'm going to throw in a toast. Call, collect, call direct, but call now. Again, that's Pam at zelmanassociates.com. So in any event, seriously, if you want to know more about housing, Ivy's the axe here. All right, so let's go to Emma. Emma, good to see you. What's on your mind, Emma?
I just heard Ivy mention, I think it was New Yorkers from the Upper East Side moving to Texas, not able to run their AC full blast. I happen to be exactly one of them.
Hi, Emma, by the way.
Hi.
Nice to hear a woman on, by the way, George.
He tries, he promotes us. But yeah, so we are able to run our AC the full blast. So you hear the news reports or things on Bloomberg. They suggest you don't run your AC full blast, but I've got a large house and the AC. Sorry, people. I'm trying to be ESG, but I'm running it full blast. It's hot out there. It's really nice because you get to have a pool, blah blah blah. But and I know it sounds like George, you're kind of really short the Upper East Side, but I miss the Upper East Side still. I mean, it's like, and the remote work point. It's hard to run a cohesive team remotely, I find. I don't know if anybody else wants to chime in about how they feel.
Emma, I would call the Upper East Side, I'm pulling your chain now. I'd call the Upper East Side a value trap, but that would imply it's a value. No, it's a melting ice cube. It's a melting ice cube.
I love it there, though, man.
I lived there for a decade, so that was my stomping ground. So I'm not there now, but I can see why you love it, Emma.
Yeah. Anyway,
but Emma, seriously, Ivy's question. You think about the unit economics, and Ivy again. Wayne Gretzky, go to where the puck is going, not where it is. But the unit economics, the taxes, the safety, as the city's tax base, exits, it just gets it's like a death spiral. And so I just look at directionally the way things are headed. I mean, how do you respond to that?
I mean, you're right, and that's exactly why I am the transplant that I am. I mean, I saw this happening and it going in this direction late last year, and I bought this property house sight unseen, flew out, bought a car, put it in the garage, got the electricity set up, flew back to New York, then came back out in July. So, in January. So, for me, it's more like I guess an emotional thing. I miss it. It's a totally different lifestyle, but you're right.
Well, Emma, to make you feel better, and you may not miss it as much, it's really not safe to ride the subways now. It's gotten really scary, and there's plenty of homeless people that are now, I think, much more prevalent that I see, and it's kind of scary at times. I was at an outdoor restaurant, and there was some crazy homeless guy that was coming by, and you hear a lot more of people getting robbed, sitting, eating outside. And so I think that, a woman my age that grew up on the Upper East Side, was there for a decade, it just doesn't feel safe. And I think that is going to also weigh in. But I was with a colleague for dinner last night, and I said, which train? Because he's going to Brooklyn. He goes, oh, no, I'm not riding the train. I don't want to get pushed in. People are getting pushed in. It's scary.
I had a policy as like never riding the subway unless I absolutely had to. So I would just run. But I would always have a taser literally in the front of my shorts. Like it was visible to all. I actually got punched by a male homeless guy in the face for literally no reason. He came up straight into my face and said, "Who gave you the right to be here?" An African American guy. And I said, "Excuse me, who gave you the right to be here?" And he punches me. I punch him. We're like straight up in the middle of Union Square having a throwdown.
God.
I know. And then, so this guy starts to follow me around, and then I let him know about the taser. I gave him a couple warnings, and then one time I just had to. It was like 2 a.m. No one's there. It's Union Square. I mean, he could have killed me if he wanted to. So I had to tase in the air, like towards his direction to get him scared, and he ran away. But these are, I mean, it's real for sure because I had to deal with it myself. So I always recommend a taser. Even the cops, like even though it's illegal, they don't care.
All right, Emma.
Well, first of all, Emma, we want to know why you were out 2 a.m. by yourself in Union Square. That's another conversation.
Well, I had the dog. He's a golden doodle.
All
I
right.
walked the golden doodle.
All right. Let's hold there. Let's try to wrap this room up here because Ivy, you can go whenever you want. We got a couple more questions here. Let's get through them, and then we're going to close the room. I want to do Kur. I'm not pronouncing his name correctly. Kur. Please keep it short, and then we'll do Invest 2, and then John. Kur, floor is yours. Please unmute yourself.
Okay. 30-year mortgages are approaching levels that they haven't been in years, I believe, since the financial crisis. You deal in real estate. Do you see this as a risk pertaining to housing demand or not?
Absolutely a risk.
Ivy, let me just say, correct. I think we covered that question. Ivy covered that a while ago. I don't think we need to go over that. There'll be a replay available. I don't mean to be rude, but there's like 1,000.
You're good, George. You're good. I didn't realize that.
There are 1,000 people in the room, and in deference to their time, I don't want Ivy to repeat herself. So thanks for the question. Please listen to the replay. Let's go to Invest 2 and then John. Invest 2, please unmute yourself.
Hi, George. Thank you for the space. Ivy, it's a pleasure to have you on today. I had a quick question regarding, I know predictions. They say predictions are difficult, especially about the future. But in regards to what you think will happen next year and the following year, does that assume overall economic growth, or does it also assume we will go into overall macroeconomic recession with job losses?
Great question. And right now, because we're not economists, we're using the current state of the economy. So it really doesn't assume a more negative impact from an economic downturn or more severe recession. So we're really looking at current job growth, what we're seeing in level of mortgage rates today, where they are, and what's priced in on the forward yield curve. So we're not really using any outlook other than what right now is the current state of the economy.
Thank you.
You're welcome. Thanks for joining.
All right. And I think the last question is going to go to, who are we looking at here? To John. John, the floor is yours. Please unmute yourself.
Thanks, George. Really appreciate the spaces, and also Ivy, thanks so much for being here today. Quick question about it, basically on the theme of comparative jurisdictions for real estate. Is there an analyst, or do you have a view on what might be likely to happen with California Prop 13? Thank you.
I think today that is a significant disincentive to consumers in California to move, and obviously a big reset on their taxes. So I don't know if Prop 13, from legislators there will come up for any type of change, but we're not factoring anything in. The one thing about regulation I want to highlight is, George, I know you wanted to ask about regulation. I'm just going to mention that there's a growing level of concern around the institutional landlords that we've all heard about, and putting some type of moratorium around their ability to purchase homes in certain local municipalities. And that's one thing, George, you asked me, and I didn't think there was much coming, but there could be some curtailment of the ability for non-primary buyers, including private investors, to purchase homes. But back to the local jurisdiction in California and what happens with Prop 13, I really don't have any insight there, John, but thank you for the question.
Appreciate it. Thanks so much.
Thanks for that, Sean. All right. So, Ivy, you've been so generous with your time. We've been going at this.
I am going to go because I have to run, but I really had a lot of fun.
No, Ivy, you can leave now. This is great. You stayed far longer than I thought. I thought we'd only get you for an hour. This is you've done more than enough. We are gonna. Since we're a bunch of financial deviants, we're going to hang out here and talk. All
right. Well, anyway, thank you so much. One thing I was going to mention, we do host a housing summit. It's going to be our last virtual one. And we had a tough decision when I was surging. And if anyone that's a Georgia Noble listener on this great podcast, Noble, we'll give you a 25% discount, and just reach out to Pam at ZelmanAssociates.com or Kim if you're interested. But it's a summit that typically we'd have a few, like 600, 700 people in attendance in person, because what we like to do is have panels where we're bringing executives, C-suite executives in each of our silos within our ecosystem, whether it be mortgage, all the things I mentioned, new construction, existing home sales, home improvement. And I moderate along with my colleagues panels, and we don't let these guys off with softball questions. And I think it really becomes very engaging. We have really phenomenal guest keynote speakers. And I think you'll find that Dennis McGill, my co-founder and real brains on the team, is a genius, and he opens with a significant state of the nation of themes that we're going to see on a go-forward basis that I think is the favorite of the conference. So we've been doing it 15 years, but please, just mention you were a listener with George on Noble, and we'll give you a discount.
Ivy, that's fantastic, and I'll be sure to tweet it out. Well, again, Ivy, we've learned so much from you. I hope you'll consider coming back in the future. This has been
absolutely
awesome.
And George, we'll follow up. But thanks, everybody. Have a
terrific.
great day.
Thank you, Ivy.
Dismissed. Take care. Bye-bye.
Hey, Dr. Anas, I sent you the mic. You want to come up and give us a Biden-Saudi update?
Yeah, so ACEs, that's a great idea. I say we go for another 25 minutes to 1:15 Eastern. And I want to close the room because it's just, I don't know, these things have become marathons. People here are so full of information and go forever. We know how that works. But Dr. Anas, great to see you.
Hey, good morning, everyone.
What's going on? What's going on, Dr. Anas?
Couple of things, basically. The first one is we have about 6 weeks ago on a show, on your show here, on your space with three aces, I mentioned that Lavrov visit to Saudi Arabia basically was pure economics, and they are arranging some deals, some oil deals. And this was important because those who were ultra bullish on oil, they assumed that Russian exports will decline substantially. What they did not know is that Russia is making deals with OPEC Plus members to export oil to them so they can use it in their domestic market, and then they can re-export the saved oil. If you recall, that was about 6 weeks ago, and some people did not like it. Well, today we have a confirmation, and Reuters basically published a report how Saudi Arabia imported or doubled the amount of fuel oil imported from Russia, and that allowed them basically to export more. This is happening in the UAE and Algeria and everyone else. So some of you might recall that talk about 6 weeks ago. The other point, and I think this is extremely important, especially in terms of politics. As you know, President Biden is in Israel, and he's going to go to Saudi Arabia. And President Biden insisted he is not going there to meet MBS or King Salman. He is going there to an international conference. This makes a big difference in terms who is going to receive him at the airport. I know some people who are against Biden. They are going to use the pictures and the videos against Biden administration. But this is really the actual protocol. Since he is not invited by MBS, and since he is not the guest of MBS and the king, then the king and MBS are not going to receive him at the airport. So he's going to be received by a senior official. But people must understand that is the protocol. This has nothing to do with any political implications or the behavior of MBS or anything else. This is just pure protocol. And the Saudis and their protocol, they have other things like if they have a guest coming from overseas, they adopt their policies, which mean that if MBS or King Salman came into the United States and the United States protocol does not allow President Biden to go to the airport and receive them, the Saudis will do exactly the same. So the point here is I urge everyone not to take this, the extra step and say, well, look, it was the deputy governor of the Western province who received him. It wasn't MBS. This is just pure protocol.
Thanks, Dr.
Thank you, Doctor.
Dr. Nas, and again, for those of you who don't know him, although he needs no introduction, Dr. Nas is like one of the world's leading experts on energy markets. We've been so blessed to have him in these rooms the last few months and help us lead the way, show us the way. And, I can say it. He's too modest, but there's a lot of listen. None of us have a monopoly on the truth. We get some right, we get some wrong. But against the backdrop of the relentless cheerleading of our energy friends north of the border, he kind of sounded a note of caution, and was when everything is up and to the left, up and to the right, he's like, well, maybe not. And aces, I don't know if you want to flesh that out a little bit, but I really want to salute Dr. Anas, along with Michael Belk and Tommy Thornton, for getting this very, very right. And so, no pressure, Dr. Anas, but you've forgotten more about the subject than we'll ever know. So that was then, now is now. You nailed it. What are you thinking now? I mean, from my little seat where I look, and I'm just an energy tourist. I mean, I got out of the energy stocks a few weeks ago, thankfully, in part because of your advice. And now that the narrative is, we possibly are going into a global recession, and given that the financial demand for oil is 40 or 50 times the size of the paper demand for oil, I'm not in any rush to get back in. And I think there's a lot of hot money in these stocks. And so, having said all that, I mean, the long-term.
Yeah, I mean, the issue is, I mean, you said it in a very nice way. First of all, are we in a recession, or we are heading for a recession? And how deep the recession is, and if the recession is very deep, when OPEC Plus will intervene in the market and start cutting production. And this is a very important point, by the way, because when Lavrov visited Saudi Arabia about 2 months ago and Bahrain, one of the things that been discussed was, okay, if we end up with a recession, Russia is on board with OPEC Plus to cut production, and Russia is willing to cut production by up to 2 million a day in case of a recession. So in a sense, they already set a floor. We don't know exactly what the floor is, but my guess is the floor is $60 Brent. It could be higher. They are going to defend the 90. So the 90 is kind of the first red line for them. But in case of recession, they cannot defend that. So it's going to go lower. How deep the recession is, we don't know. But in case it is very deep and we go below 60, I think they are going to start cutting production again. And the Russian commitment is very clear. The OPEC alliance is stronger than ever. The Biden administration tried to break it, but they misunderstood what that alliance is, because they thought it's only about oil. Really, as we mentioned in previous spaces, this is way more than oil. It's been known since 2017 that this is way more than oil. As you all know, or most of you know, that when the Saudis got stuck on the Yemen issue, it was Putin who used the veto power in the UN Security Council to stand with the Saudis. It was Putin who stood up against the climate change resolution at the UN Security Council, because that UN resolution on climate change would have literally destroyed the economies of the oil-producing countries. Biden cannot afford these things to the Saudis. A final comment on this is Biden visit to Saudi Arabia. This has nothing to do with oil. Oil is a secondary issue, but the administration have no choice but to say what Jack Sullivan said. Oh, we are going to pressure the Saudis to increase output. But they have no other statement to say. That's it. I mean, they have to. That's one point. The other point is, it is possible for the Saudis to increase supplies, as kind of they can extend an olive branch to Biden and say the following: we are going to extend supplies in the fourth quarter of this year. That means the oil is going to arrive in the market after the elections, and Biden knows that. So why waste political capital trying to force them to do anything before that? So probably this is going to be a secondary issue. The Saudis might say we are going to increase supplies in the fourth quarter. And notice that I said supplies. I did not say production, because production is one thing, supply is another. And UAE, Kuwait, Iraq, and Saudi Arabia can add north of 700,000 barrels a day of supplies, not production, of supplies in the fourth quarter. If we have a recession, it's a crisis because adding that amount is a problem, but they may not add it at all if they found out we are in a recession. Back to you.
Thanks, Dr.
Hey,
Nuss.
hey, George, some breaking news.
Yeah.
Mario Draghi just resigned. Boom! Another one falls. I'm trying to get justice up, Bobby J, but he won't. He's in and out. He won't take the mic.
Yeah, I mean, look, the fault lines are starting to really get stretched here. I mean, you and I were going back and forth this morning. Something's going to break. You know, euro, the yen. It's all coming apart. So, you know, there will be casualties along the way. So just talk to this one. So, Aces, who's up to speak next? Aces, who is it?
Wait, Carice. Hey, my brother, come on up, my man.
Well, Emma had her hand up before me. You guys just brought me up. I do have a question.
Emma's been speaking. She's already spoken. She'll talk again when she wants to. Carice, you got a question?
Yes, I've before I start my question, I just want to say thank you for what you do. I learned so much in the last couple of times I've been in this space about a myriad of financial issues. I'm a local elected official in Utah, and for me, these issues matter to my people, and I wish more elected officials would actually listen to financial people about what their views on things. But with that said, my question revolves around simply when it comes to inflation. Aces, you had said something that was groundbreaking, and I can't remember all of it, but it was in regards to tracking aspects of if we're going to get into a recession and using gold yields and things of that nature. I mean, that's the type of thing I'm trying to do an outlook on, because when you talk about taxation on your communities, especially, the only level in Utah we have for taxes is property tax, of course. So I want to be a good steward of those taxes, but I have to have the municipality run at a way that's lean, not over bloated of a budget, but at the same time not accounting for inflation or recessionary curves, so I could best serve my residents. So
Sure.
Can you talk a little bit about that? That'd be great.
Hey, Carice, we've got only a couple of minutes left in this space. Do me a favor, look in the nest, okay? There's a gentleman there by the name of Michael Cantro. Everything that I talk about on Spaces is stolen from him. So do me this favor, follow him, read everything on his timeline for the past 2 weeks, and then the next time you see me in a smaller space to where we don't have thousands of people and an agenda here, I'll be happy to give you a master class. Deal?
Thank you so much.
Anytime, my brother. I think Gordon's next, Jordan.
Gordon, what's up, man?
Hey, guys. Just a real quick question. Interesting thesis I heard yesterday, actually, a bear thesis on gas prices. If you look at 3-2-1 crack spreads over a long period of time, they're up pretty significantly. And in short, the theory is that, as that spread contracts, it's going to have a very negative effect on gas prices in the back half of this year. Just wanted to know if anybody had looked at that, anybody's thought about that. Thanks for the question.
I think that's an Anas thing. Hey, doctor, do we have that gas?
Yes. Will you repeat the question again, please?
Yeah. So the thesis is that if you look at 3-2-1 crack spreads, if you look at them since, I don't know, go back to 2009, and you look at where they're at now, they're very high. So the thesis is as they normalize, so too will crude derivatives like gas, etc. So if the price of crude can stay high, but the price of gas, diesel, jet fuel, etc., falls, number one, you'll have a fall in those prices. But number two, it'll actually bring down inflation, and thus a lot of the guys out there calling for excessive inflation could be proven wrong by this dynamic. And I haven't heard anybody talk about this, but a smart guy brought this thesis up to me yesterday. So just wanted to see if anybody had thought about that.
The refining industry went through this so many times in the past, so this is not new to them. And refiners can play several games, especially the more sophisticated refineries. They can literally switch the crude quality to get different cracks out of them. so they can even the worst play that and play the crude quality issue. The issue becomes a problem for the simple refiners who have no other choices in terms of crude quality. Back to you.
Thank you.
The other
So-
thing I would say, Gordon, is if you have a time, reach out to Doomberg. Doomberg has a library of content, all custom researched and put together on his Substack. I don't know that there's a better source on planet Earth who's been talking about this stuff in detail for 6-9 months or so. And, you know, if you need some help getting through some of his content, I'm a pro subscriber, happy to help.
Gordon, you got a follow-up, Gordon?
Sorry, that was a mistake. Thank you.
No worries.
Yep, anytime, brother.
So I don't know, Aces. What else you want to talk about? I mean, we've gone it's a little over 2 hours. I mean, go back to the monologue maybe at the beginning, as you and I were talking earlier today. I mean, something's going to break. It is breaking. Things are fraying. I see the euro now is we're through parity. DXY is 108.90. Interestingly, bond yield up today to 297, despite the fact markets are getting schmeiced, which is not good for equity. So I'm just looking at my screen here. Kind of interesting how energy stocks go from weakness to weakness. They're just getting absolutely destroyed. Absolutely destroyed. And, it's funny, tongue in cheek, in looking at my feed this morning. How should we say? As you're aware, Aces, energy happens to be a topic where there are some, how shall we say, some rather energized points of view on the commodity. Some people feel very strongly about it. And I had the temerity to repost Michael Belkin's call from the middle of June 20th, where he said it was entitled Genesis of Energy Price Top, and he had tomatoes thrown at him. And then I put a follow-up tweet in case any of you are wondering if Belkin still has energy as a short, and I excerpted Michael's comments on energy from Monday this week, and the reality is he still has energy as his top short pick in the market. And sometimes we get it right, sometimes we get it wrong. Hats off to Belkin, to you, to Tommy Thornton. We're going to make a lot of mistakes. I just wish everyone would treat others with humility and respect, whether they get it right or they get it wrong. I'm not going to mention names, but I'll probably get in trouble for saying this, but what the hell, since when did that ever stop me? I know the point I started to make, which was talking about the Twitter mob. And someone was making the point about how, there's a lot of FinTwit energy bulls out there, and it's consensus trade, not a consensus trade. And so I paraphrased that line from Kramer, which is, guys, not he's a disaster, but he's got that line he always uses on his shows, something to the effect, there's always a bull market somewhere, and my job is to find it and help you make money. And so I took it and play on words. I put, there's always a Twitter mob somewhere, and my job is to find it and help you make money. And whether that means going with the crowd on the way up or fading it when it goes the other way. Usually when there's a Twitter mob, at some point they're going to wind up being the wrong way. I'm reminded of something George Soros wrote many years ago in one of his books. He spoke about the way to make real money in a market is figure out. I mean, you don't want to be contrarian for the sake of being contrarian. That's just stupid. You want to go with the flow most of the time, but the way you make real money is you figure out what it is that the market believes that you think is not true. In other words, where you have a variant perception. What does the market believe that's not true? What does the market believe that's a lie? Or what does the market believe that's not sustainable? And then more importantly, try to figure out when will they realize they've been had? When are the tables about to turn? And just when you're on the cusp of that, that's when the landslide starts and you go the other way. And, you know, you were a little bit early. Maybe Michael Belkin was a little bit late. Doesn't matter. I mean, Tommy Thorne was probably more right than any of us. But man, was that true in spades this time around the track. So, Aces, let me ask you. I know you're not short energy. I don't think you ever shorted energy. It merely was an expression that you thought it was overcooked. And, you know, time for correction. And it's kind of the way I thought as well. But now with energy stocks having gotten absolutely destroyed, what are you thinking here? You got any appetite to want to nibble, or do you want to see the charts bottom out? Do you want to see people start to figure out that what the recession is going to look like, that how long it will be, how shallow it will be? Like, how do you think about energy stocks here, Aces? Because on the one hand, you know, you could say calling a short a few weeks ago, a couple months ago, that was an easy call, hard call, whatever. But the fact of the matter is, prices are down a lot now. So, if you were entering the market today and you don't get to take a victory lap because you're Aces and you called the short correctly 3 months ago, and you're not an idiot because you bought them like Kramer did, you know, 3 weeks ago, clean sheet of paper, new client, $100 million bucks. What would you be doing with energy stocks now? Would you be buying any? Would you be waiting to see how it plays out? Like, well, where's your head at on this energy trade right now, Aces?
Well, I mean, first of all, you know, energy diesel is my single largest operating expense by a factor of 3 or 4. Okay. So it's very material to my day to day life and stuff like that. But personally, I mean, in the commodity space, George, in the mining space and the resource space, very few people understand this. Very few people pay attention to it. I don't hear anybody talking about it. The value to a company in the industry, in the resource, in the materials industry, the operating leverage comes from the grade of material, not the commodity price, right? So in my business now, if I could get the head grade of my, you know, grams per ton going into my machines from 1.75 grams per ton to 2.25, the operating leverage in that is far better and far more, you know, interesting than, you know, gold going from 1800 to 1950 kind of thing, right? So if I'm going to do anything in materials, I'm going after the best grades on the planet, right? And the best grades on the planet are in the Permian Basin. So the stock there, that's my favorite, is a company called Diamondback Energy. That's my go-to stock whenever I want oil exposure. The symbol is FANG. 83% gross margins, 45% earnings, you know, free cash flow margin. I mean, it's just a poster child for, the preeminent number one resource company in the world, in my opinion. So, you know, that's my focus is on the good stuff, on the good grades, because they have the best oil in the world coming out of that place.
But Aces, you know what's really amazing? I'm looking at the chart. It's ugly. I mean, it's a great company.
Correct.
But as we know, but as a stock, I'm looking at it. This thing has gone down so fast. All right, it's gone down. It peaked at 160. Had a spike peak at 160. 160 closing peak of a 160 and 40 cents on June 7th, so 5 weeks ago. All right, and I pull up the chart. You know, it's gone. It's at 104 right now, so it's gone. It's had a 33% off sale. It's back to where it was, despite, think about this, Aces, despite all the hullabaloo and all the song and dance. Okay, this stock has fallen all the way back to where it was last October. So despite all the cheerleading and the pom poms for the last 8 months, 9 months, stock's gone nowhere, which to me is kind of mind boggling. I mean, how do you think about that?
Well, I think welcome to my world for the last 12, 14 years being in the mining industry. It's crazy. It's feast or famine. One day you're picking out Gulf Streams, the next day they're coming for your refrigerator. It's been going on forever, right? So basically that's why I use the public markets, is to offset that cyclicality in my personal business. I'm a short seller, right? So listen, it was 45.50 when Numbnuts announced the closure of the Keystone Pipeline XL. It was $50 and it went to 160, right? That was one of the reasons why I was like, there's just no way. All right. Now, here's the thing. Dr. Anas has nailed this to the T, for 6 months. Oil, because the maxis, which by the way, George, and if we're honest with ourselves, from tulips to oil and gas to Bitcoin, I have never seen a maxi shill, crowd make it out of a trade alive. And we've been saying that now for a little bit, a while there, right? Like you just were kind of touching on, right? So I've never in the history of the market seen a maxi crowd come out of a trade in one piece. And that's what you got here, right? So, but the reality of it is if everybody's superimposing the horror story of ESG, everybody's superimposing the horror story of this administration and policy and energy and stuff like that, right? And they're 100% correct in assessing those risks to the hydrocarbon complex, but it's just not the right time. Dr. Anas has been publishing one chart after the next saying, yes, supply is down, but on a demand adjusted basis, it's in a 40-year range, So, I mean, we hear the oil ministers in various countries, the market's well supplied. You don't see these oil and gas guys out doing huge mergers and acquisitions and buying acreage and stuff like we used to when oil would get to 70, 80, 90, $100 a barrel. Remember all those deals they used to go off when oil and gas would hit 70, $80? Boom, you start to one after the next, all the acreage plays and Aubrey McClellan and all that stuff. We haven't seen any of it.
100%.
So,
100%.
right. So I'm following those guys, not the storytellers. So FANG, again, it's still up 100 and some odd percent in less than a year. Maybe start nibbling on it. I don't know. It seems a little early to me, especially, just one little thing on Cantro, if you don't mind. So on the CPI stuff, right? So everybody's running around talking about CPI, and basically, so what Cantro's been saying now forever, but most recently, very emphatically, is that forget about year over year CPI. Forget it. It's a waste of time. You got to look at month over month. And he's saying in order for CPI to get to a range to where it's in the zone, it needs to be 25 basis points month over month. If anybody here has looked at the month over month CPI print yesterday, it's 130 basis points. So just as a little bit of a barometer in terms of expectations about peak inflation and pivots and pauses and all that stuff, we need inflation to come down 80% month over month to get anywhere near that conversation. I just had to plug Cantro there because he, like Dr. Anas and you, have been one home run after the next, spot on, predictive. And, I like to acknowledge people who are right, because we get on these spaces and we get on Twitter and people make good calls and bad calls, but nobody comes back and says, hey, these are the guys who are getting it right. So I just wanted to put that out there.
Listen, Ace is very kind to you. God only knows I've probably made more mistakes than anybody in this room because I'm older than anybody. And it's nice to get it right once in a while. And this year we've gotten a lot right. Trust me, there have been years I've been pretty wrong. But everything I look at, what I really like about this room, and by the way, Bobby J's here. Get him up. Aces, he's down there. Get him an invite. And K-Fab's
I've been trying to get both of them, but they're being tried.
All right. But at any rate, there's a lot happening right now, a lot coming together, a lot to do, a lot of ways to lose, as far as I can tell. We got K-Fab here. This is great. And the glass half empty crowd they're in denial. They're just, they don't want to open up their statements. They think it's going to go away. And, you and I aren't making this stuff up. Every week, every day, every week, a new disaster presents itself. And, just when you think you run out of bear arguments, comes a few more. And I'll go back to what I said a couple of hours ago, and I said it the other day in the room as well. Is there anybody that I respect who's bullish? Who's in my sort of, council of senior advisors or whatever? And the answer is no.
So maybe they're stupid. I don't know. But when the facts change, I change. What do you do, sir? John Maynard Keynes, please call your office. KFAB, you got something to say for yourself? Welcome, KFAB.
Yeah, hey, George. Hi, everybody. I'm so struck with the last two spaces because they were in two domains that, I kind of like you say, George, I'm a tourist. Whether with Larry, with kind of the geopolitical piece, and then today with the real estate market, and where I think I bring value is kind of the top down, the different silos and putting the pieces of the puzzle together. And I was struck today by the comment late in the discussion that her base case was basically assuming, kind of everything's okay. And that sounds fairly ominous, even in an okay scenario, right? And you and I, George, have talked about this. In an okay scenario with earnings, it's really bad, just with margins going back to reasonable levels. No one, and again, even with you, George, I still am just taken aback by how hard it is for people to get their minds around the fact that the base case here is an ominous one. That's the base case. Just because, and that the comments about the velocity of things, that's the kind of thing that piques my interest. I'm starting to see that across different things, different domains in the economy, globally, and all of these things are happening coincidentally. And as I've been saying, what the pandemic did is that it hit a reboot button. It's like every global economy, every region unplugged their economic business cycle router all at the same time and plugged them back in. So whereas you normally have business cycle diversity, like in 08 when, China and India were okay, you don't have that right now. There's no engine that is dispersing from the global business cycle. And, all of these scenarios, I try to push people and say, okay, what if there's a global recession? And no one wants to talk about it. What's your base case if it's a severe global recession? And, because to me, that's not esoteric. Like, that's becoming the base case. That's what Larry said on Tuesday. It's like, okay, well, what does that mean? Given what we just heard today on real estate market, what does a severe global recession mean to that domain?
100% KFAB, 100%. One of the reasons I really like you is respect you is you think outside the box. People they don't want to go there. It's not the way their minds work. And no, you're spot on. You are 100%. And
I don't want to go there either, George. But
I know, but you got
you know what I mean? It's like not fun stuff.
But I consider you to be a realist, not a pessimist. It's like the down cards are being turned up one by one, and it don't look too good. So Anyway, let me change subjects here completely for 1 second. So we're going to have a kind of an open mic thing here for the next few minutes. So we had some really, really excellent rooms. I don't know about you, but just I'm in love. Ivy can come in here anytime she wants to talk housing as far as I'm concerned. And Larry, just phenomenal. So many great people out there, and we've had a lot of great rooms. And so I'm trying to figure out the direction we're going to go next. And if anyone has a suggestion, wants to raise their hand, nominate a couple people, come on up and tell me why. Not just because he's a good guy, but if there's some sort of differentiated point of view that would be helpful. I have a few names here I'm just going to throw out to the crowd if any of this resonates with anybody. I'm trying to get John Hussman. I think he would be a terrific speaker. Fred Hickey, who has been around a long while. He's a precious metals guy, but he's a really smart tech guy. Don Cox, retired, former strategist from BMO. Stan Weinstein was a huge hit a few months ago. I thought we might get him back. Chris Ferrone. Former colleague of mine from Fidelity, Jurgen Timmer. Joel Chillinghast, who runs the Fidelity Low Price Stock Fund, or at least has run the fund and is retiring or has retired. Rich Bernstein. David Rosenberg, but I don't know. Rosie's pretty well exposed. I don't know how much new we're going to learn from him, but might be nice to have him stop by anyway. Hold up, Emily, let me get to the end, and then they can weigh in. Jeremy Grantham. Albert Edwards. Now, there's a name, really smart guy. Works for SocGen out of London. Banks, Gerard Cassidy, veteran bank analyst. Grant Williams. Grant's always interviewing people, but I want to interview Grant. Grant was interviewed by Michael Gayad in a space earlier this week. I urge everyone to go. Actually, the interview was done a couple weeks ago. I urge everyone to go listen to that because Grant is brilliant. And then, do I dare say, and people can say, George, why? Greg Foss, he's a maxi, Bitcoin maxi, but he's a sensible guy, and he has a background in fixed income markets, and has this cockamamie valuation framework for Bitcoin, looking at it as sort of like CDS and the dollar. So there's, I don't know, a dozen or so names sort of top of mind of potential speakers for an upcoming space. If anyone wants to weigh in on any of those names, or anyone else has another name they'd like to suggest, please have at it. Carpathia, I see you're up on the stage. Carpathia, what's on
No,
your
I
mind?
was just going to throw out, I don't know, Keith McCullough, hedge eye.
How should I'll be diplomatic. He and I don't see eye to
All
eye.
right, that's good enough.
No, I'm going to leave it. You got any other ideas?
I'll get back to you.
I've got some ideas. How about I think his name's Mike from Cornerstone Analytics. He was interviewed on Grant's podcast. So if I'm saying the first name wrong,
You talking about my good friend Mike Rothman?
yeah.
Yeah, okay, Mike Rothman. Just so you know, I'm very good friends with Mike. You're kind of new to this room, I know, Emma, but with Oliver Parsons, who's his sales guy, stood in for Mike and spoke in this room 2 or 3 months ago. Mike was a little bit hesitant about speaking in the space.
Gotcha.
But we'll try to get it. It's a good idea. Maybe since Oliver had a good time here and reported back to Mike, and Mike heard the space, maybe he'll agree to show. But I agree. Mike Rothman is the best oil analyst that I follow. I don't try to count the barrels. Trying to predict oil prices, as we all know, is a thankless task, but he does as good a job as anybody on it. So anyone else come to mind? Emma or Aces or KFAB or Gordon? Anyone else?
Chano.
Chanos is great, obviously. And then also, this one might raise hairs or issues. Kyle Bass, a friend of mine, I can probably help get him on it.
Can I ask you a question? I say this respectfully, Emma. I'll choose my words very carefully. Kyle's a very smart guy. Kyle's very eloquent. Do you have any sense of how good his investment ideas are, or what his track record's like in terms of making money?
His track record is actually pretty excellent in terms of making money. There's the media has his positioning wrong all the time. He's had one real bad one recently, but he didn't even let me invest in that special purpose vehicle, which was a short Hong Kong dollar SPV using options. So that, there was an expiration date, and it expired. But beyond that, like where everybody thought he was wrong, the yen, he actually wasn't. We all know he did well during the 2008 housing crisis. He did extremely well on Iceland. He predicted the collapse of the Icelandic banking system, and then predicted the 2011 to 2013.
Yeah, I guess Emma.
So he did pretty good. Pretty good.
I mean, his public predictions is one thing. Have you actually seen his investment results? That's the question I'm asking.
So I haven't seen every single one of them. Let's put it that way.
Okay.
So he could have offsets that are worse than what I've seen. You know what I mean?
Sure. Okay. That's fair. That's fair.
How about Fleck and/or Stephanie Pomboy?
Okay, so Pomboy, actually, that's a great suggestion. Pomboy's on my list. It's funny because I reached out to Grant a couple of months ago. I said I want to interview you guys, and he's like, "Just me or Steph and me or whatever." So Pomboy, great idea, Carpathia. What was the other name?
Fleckenstein.
Yeah, Fleck's a good guy. I know Fleck. I can get him. He'll come on.
All right.
Good. All right, this is helpful. Any other thoughts, comments?
One more. Peter Zeihan. He's a geopolitical strategist.
Oh yeah, no, we got to get Peter in here. We'll do that. That's great. That's great. No, this is excellent. I'm glad we got some more ideas here.
My one idea, Georgia, because you named a bunch of them, is Lakshman Achuthan from ECRI.
You think he'd do it?
I bet you he would.
Okay.
Yeah, and if you want, I can kind of. I mean, I don't know him that well, but I could probably get a response from him at least.
Yeah, you know what? If you wouldn't mind running with that, that'd be great. If you have some contact with him, he's more likely to respond to you than I. But that's a great idea. That's a great idea.
Okay, I'll find out.
You know, it's funny too because I've been thinking a lot about these spaces, and you know, it's not everybody's cup of tea. I get it, but I really value the long form nature of these conversations because they can be meaningful. And listening to Grant Williams speak with Michael Guy the other day, that was one of the values that he cherishes, and I'm totally with that. I don't want to get into these, soundbite type things where things can be, thoughtful ideas. I mean, let's say on the one hand, if you can't explain it in a sentence, it's not worth explaining. But on the other hand, usually it's the detail, devil's in the detail to understand the context. So I really value these rooms, and to me, it's extraordinary that so many of you hang out in these rooms for such sustained periods of time. So definitely means something. And I just look at this room today. I think I've lost track, but I think we've had over 1,000 people. I don't know what the cumulative count is so far, but the turnout's just been phenomenal, and the rooms keep getting better. So I want to thank all of you. Anyone else got anything to say? Otherwise, I think we're going to close it.
To George, I just want to say one thing, because I know you and Anas and Cantrell will never say anything to give yourself a pat on the back. But listen, I'm in these spaces at 10, 11 o'clock at night, talking to people, and they're coming in by the hundreds, okay? And I just want to let you know something in all seriousness, okay? Every other person that comes up is coming up and trying to communicate in a way, but they don't have the confidence to completely do it. And like one after the next, the same, and but George says this and George says that, all in such 100% just complimentary, beautiful. George, I'm just telling you right now, what you're doing here with these spaces and these guests and the way you're handling this, you are having, I'm telling you, one of the most outstanding impacts on such a large group of people, and turning them into financially literate people who can take care of themselves, their money, their families, and not get buried in shit by all that stuff that goes on Wall Street and stuff. I just want to acknowledge that you're doing an unbelievable thing for humanity.
Aces, I'm humbled. I'm embarrassed, and everybody. I didn't tell him to say that, and I didn't know he was going to say that. But that's the feedback. I got a lot of DMs from people, and that's what energizes me. I talk too much. I'm not everybody's cup of tea. I understand that, but you can't please everybody. I just try to do what I think is right, and it is so gratifying to know that some people are benefiting from this. And I get all these, all my DMs and whatever. So, thank you for saying that. And I get a lot out of this too, as I've said many a time. I look at the room today. It's not just Ivy, but my God, there's a fella, Michael from Boise, Idaho, a builder. I have no idea who this guy is. I would never know him if it wasn't for Spaces. He comes out of nowhere. Our good mutual friend Jackson, I still don't know who he is, but it doesn't really matter. I mean, it's just extraordinary. So I try to give back. I benefited. I was in the right place at the right time. And I try to give back some of what I've learned. But I'm still learning. And so this is great. We help each other. We each bring different experiences and areas of competence to the table, and we all are better for it. So thank you for that, Aces, and may this room continue to go from strength to strength. All right, so listen, 2.5 hours, enough. This has been awesome. I'm not sure what next week. We might do something on the weekend. We'll see. Anyway, it's been a great room. I want to thank everybody, Aces, Emma, KFib, Carpathia, Gordon, Dr. Anas, everybody, and Ivy, and those who already left. This has been a phenomenal room. We'll do it again. Have a great rest of the day. Take care, everybody. Bye-bye.
Rock and roll, my brother. Thank you, George.
Bye-bye. Bye-bye.
Take care, George. Take care, everybody.